Yep, I had to do it. I mean, it's the beginning of May. Knicks are making a bit of a run in the playoffs. Got to rock my Knicks shirt. But we just came through a market correction. As you all know, I've made 2 videos on that, on how to think about it. Things seem to be turning around in the right direction. Knock on wood, fingers crossed. But last week, GDP came out with a negative reading. So I know that I started getting some questions from clients on how this impacts everything. I know that other Osaic Wealth, which is our independent platform that we work off of, also started getting questions. So Phil Boncato, who's the chief investment officer of Osaic, also put out something to the advisors, just giving some thoughts on what him and the team had been thinking or are thinking in terms of GDP. But again, the main questions we were getting were, should we be concerned and how does this really impact my portfolio? So in today's video, I'm going to explain what exactly GDP is, what it tells us, and even doesn't tell us, and how we as financial advisors use it in context when managing our clients' portfolios. So what is GDP and why should you even care? GDP stands for gross domestic product. And basically what it is it's the total market value of all goods and services produced in a given country during a specified period of time. It's often described as basically the economy's report card. So when GDP is rising, it generally signals growth and companies are producing more and people are working and consumers are spending. But when GDP falls, adjusting for inflation, it may indicate that there's a slowdown or some sort of possible recession coming. So in the US, GDP is typically measured and announced on a quarterly basis by the Bureau of Economic Analysis, and it's reported really in 2 forms. First, you have nominal GDP, which is basically based off of current prices and not adjusted for inflation. And then you have real GDP, which is adjusted for inflation and even gives a more accurate and sort of read on economic growth. Now, how is GDP actually calculated? There's really 3 main ways, and that is based off of the expenditure method. That's the most common one. So basically the formula is GDP equals C plus I plus G plus, in parentheses, X minus M. So the C is for consumer spending, I is for business investment, G is for government spending, and X minus M is for net exports, meaning exports minus imports. So the BEA basically pulls all this information together through a variety of methods, whether it's like surveys or government reports or some business statistics that are out there to estimate the numbers. So in short, GDP reflects everything that's being bought and sold within the US economy. So what happened in Q1 of 2025 for GDP, just as a recap, just so you could see why this kind of came up? Well, obviously we were going through a correction in the market, so people were looking for some economic indicators to, come up with conclusions or, figure out how they're going to manage their portfolio. But the nominal GDP rate grew at an annualized number of 3.5%. But real GDP, which again adjusts for inflation, was down 0.3%. This means that the economy was still producing more in terms of dollars, but inflation adjusted output actually shrank a bit. So naturally, markets and headlines responded cautiously to it. But with all that being said, this is where we come in as advisors, because GDP is really just one signal, and how we interpret it really does matter. So from a portfolio management perspective, GDP it's a valuable economic indicator, but it's also a lagging one. We only see the data after the fact, often weeks after a quarter even ends. So while GDP confirms economic trends, it's not something that we use to make knee-jerk investment decisions. We would typically focus on year over year, quarter over quarter numbers to get just really some sense of long-term momentum. But as I was saying before, GDP, while important, we need to look even farther to get more context into what's going on. It's important that you combine it with other data such as unemployment, inflation, corporate earnings, and consumer confidence. So how exactly does GDP help us as far as managing a portfolio for a client? As I mentioned before, we look at it amongst other economic indicators to really come up with some sort of decision on what's going on. But for example, strong GDP coupled with rising inflation, we may look at more inflation hedges and some more defensive positions. Weak GDP with falling inflation could suggest future stimulus, which may favor growth assets and even longer duration bonds. Now, with contracting GDP, often that shifts our focus really to more defensive sectors like healthcare, utilities, or even other staples. We also watch GDP just in terms of upcoming earnings expectations, as well as the influence on Fed policies. Both of those basically influence market returns and even interest rate trends. So how do we manage portfolios among GDP trends? And this would be the same if you were managing your own portfolio. Number one, we avoid overreacting. As I mentioned, it's one report. It can be revised multiple times as well. And often the markets are forward looking. A lot of the market pricing is already priced in. So that bad news that possibly could be coming down the line is already accounted for. So number two, we watch overall trends, not headlines. Again, we don't make rash decisions off of just one report for one quarter. One negative report is not going to overhaul the whole plan. We also stress test our portfolio. So I talked about this last time. We do use a tool called Nitrogen Wealth, where it will, as well as Y charts, which is another great tool as well that us as advisors use. And it allows us to stress test the portfolios in different market environments, whether it's a bull market, a bear market, great financial crisis of 2008, as well as the coronavirus and what happened in 2020. So this allows us to see how different allocations within a portfolio will react, as well as to see how aggressive the actual portfolio is, looking at it from an analytical number, almost like a speed sign. So it's very helpful for a client to just see it in one number, basically telling us and the client that their portfolio is going too fast, or maybe it's going too slow. So if it's going too fast, you could see a significant decline in the portfolio when you get a market correction like we just went through. If it's the other way around, you'll probably hold more steady, but you're not going to grow as much during the times when you get a bull market. Also, and I'll kind of finish this with this, is that it's always just important to reinforce and just understand what the long-term plan is. You don't make economic decisions off of short-term noise. So as long as if you've done your work up front as an advisor and even as an individual who's investing on your own, and you know what you're trying to achieve in terms of your overall long-term goals and strategies, and you've done the work up front and have a properly diversified portfolio, again, we've talked about this in other videos, then you're going to be in good shape. But also behavioral finance comes into play. So it's important to not get so sucked into the headlines in terms of what's going on, and to stick to the plan and just be diversified across all different asset classes. So again, some final thoughts. I mean, again, GDP, while it makes headlines and it's often talked about, it's kind of easy to feel like, hey, there's things are maybe slowing down. We might need to, we're going to need to adjust things. But more often than not, what's needed is just some perspective and let things flush out a little bit, and then possibly look to make changes. Again, GDP is a useful piece to the puzzle, but it's not the answer to everything. Again, as we mentioned before, it's a lagging indicator. And it's also one of the many indicators that we use, that any manager or advisor is going to use to evaluate your investment strategy. But the way I see it is, our job is to weather your portfolio through the ups and through the downs, not just to chase every single data point that comes out there and every piece of news, because that just won't work. So as always, and as we've seen over the last 2 to 3 months, stay diversified, stay disciplined, and you'll be in good shape. If you found this video helpful, please give us a thumbs up. It really helps us grow. Feel free to send us an email, give us a call, let us know what you like, don't like, so that way we can tailor our content for future content. Also, please subscribe, so that way you can stay up to date on additional content that we'll be putting out over the next couple weeks. Thanks for watching, everybody. Go Knicks. We'll see you in the next one.
If you're ready to take your financial planning to the next level with a customized approach, feel free to reach out to us. This way we can help determine if we can even help you or even point you in the right direction. The best way to reach out to us is through our website at sandersmith.com. Thanks for watching. For more valuable tips on financial planning, check out those videos here. And if you found this information helpful, please like and subscribe so you don't miss any future content.